Alright guys, let's quickly revise Forex better. The first thing that I told you guys in this chapter was the concept of exchange rate. Exchange rate guys is the value of one currency in terms of an other currency. Whenever you're expressing the exchange rate as such guys, there will be something called as base currency guys and then counter currency. Instead of using the word base currency and counter currency guys in the class, we've always used the word commodity and price. If the ongoing rate as such guys is $1 is equal to 88 rupees as such guys, we would say better that $1 is the commodity, 88 rupees as such guys is the price of dollar in terms of rupees. So whenever an exchange rate is given guys, because there are two currencies involved, you will have to first identify which one is the base currency, which one is the counter currency. Indirectly, which one is the commodity, which one is the price. By default as such guys, I told you whenever they use the word equal to, symbol equal to as such guys, whatever comes in the numerator as such guys will be price, whatever comes in the denominator will be commodity. So if I mention rupees by dollar, it would mean better that rupee is the price, dollar is the commodity. If I mention dollar by rupee as such guys, dollar is the price, rupee is the commodity. Sometimes guys they may not mention the symbol equal to guys. I told you in such questions you will have to identify what is price, what is commodity based on the prevailing exchange rates. Identify which currency as such guys is stronger, which currency is in weaker, matlab inexpensive in terms of the other currency guys, and then check whether the quote is less than 1 or more than 1. So if I tell you better that dollar/rupee is 88, undoubtedly as such guys, this will not mean as such बेटा that 1 rupee is equal to $88. एक तो अगर वो equal to use करा समझो बीच में, if they get mentioned like this, nothing doing as such better, you will have to write that 1 rupee is equal to $88. But if this equal to symbol is not used in between, then better I will have to go by the prevailing quotations. Obviously better here I told you this is how better quotes are also given in the market. इसका literal meaning ऐसे रहता बेटा $1/88 rupees. This is how it means. So here beta, though dollar is coming in the numerator as such guys, this means dollar is the commodity beta and rupee is the price. Other way beta, if they give rupee by dollar beta, I say 0.0123 guys. This does not mean beta that $1 will buy you 0.0123 rupees. You will have to go by the prevailing quotes as such guys. Obviously, which one is a stronger currency? Dollar is a stronger currency. Is the quote less than 1 or more than 1? Less than 1 guys. That means 1 rupee as such beta is going to buy you lesser number of dollars. $1 will not buy you lesser number of rupees. So this is the first thing that you're supposed to do guys. Exchange rate, I repeat, involves two quotations as such guys, two currencies. Identify which one is commodity, which one is price. This becomes even more relevant as such guys when you know the way the quotes are given better will be specified in the question. One way quote or two way quote guys. So abhi ke liye is this part clear guys. After that guys, I told you just for knowledge कि in reality better exchange rates can be under pegging system or they can be under a floating rate regime. Floating rate regime better is where the rates are freely determined guys by the market, or it can be a fixed peg wherein the rate of one currency in terms of another currency is fixed. I gave the example of dirhams guys. AED ka $1 is always equal to 3.6725 dirhams as such guys. It can be a soft peg wherein they specify a range guys where the price of one currency will always range in that only. Hong Kong dollar follows soft pegging system. Not relevant for examination as such guys. Is this clear better? Then guys, we moved on to the concept of direct quote and indirect quote. Direct quote and indirect quote as such guys would be useful only if they ask us to quote something as such guys. They said if they mention in the question, find out what is the direct quote of dollar in India. So that is where we will use the concept of direct and indirect quote guys. Otherwise better subsequent questions we were not bothered about whether it is direct quote or indirect quote. Kya to karna hai? Objective is only to identify what is commodity and what is price. So direct quote better would mean that you are making home currency as the price and foreign currency as the commodity, like any other product that is available in the market. You go to a supermarket, buy guys a juice packet as such better. Then obviously that juice as such guys is a commodity and the price will be stated in terms of rupees. Think of the supermarket as an authorized dealer. You approach him guys to buy dollar. Dollar becomes a commodity. Price of that dollar beta will be stated in terms of rupees. So by default as such guys, any country would want to make their currency as price and they will make foreign currency as the commodity. That is what is called as a direct quote, wherein we write number of units of home currency divided by 1 unit of foreign currency. Indirect quote as such guys is where your home currency is made the commodity. You write number of units of foreign currency divided by 1 unit of home currency. I told you UK follows indirect system, guys, wherein they make pound itself as a commodity and they make all the foreign currencies as the price. That does not mean as such, guys, just because the word UK is given, you assume that it is indirect quote or direct quote. We still have to go by the prima facie rule, guys. What is the prima facie rule? If the symbol equal to is used as such, guys, whatever comes in the denominator is the commodity, whatever comes in the numerator is the price. If the symbol equal to is not used as such, guys, you go by the prevailing rates and then identify what is the commodity and what is the price depending on whether the quote is less than 1 or more than 1. Are we clear about this, guys? After direct quote and indirect quote as such, guys, we moved on to the concept of one-way quote and two-way quote. Now, one-way quote as such, guys, would mean that there is a single rate as such, guys, that is given for both buying and selling of the foreign currency, guys. Two-way quote as such, guys, is where bid rate and ask rate is specified. Alright, guys. One second, sorry. So, guys, I was talking about one-way quote and two-way quote, guys. One-way quote would mean that there is a single rate as such, guys, that is specified for both buying and selling. A two-way quote as such, guys, would mean that there is a separate rate given beta for buying, separate rate given for selling. This is called as bid rate and ask rate. The words bid rate and ask rate as such, guys, have been coined from the viewpoint of the dealer, from the viewpoint of banker. A banker would always buy at a lesser rate, banker would always sell at a higher rate, guys. So in case beta I give you 85.2 to 85.6 rupees per dollar, it means, guys, that a banker would be buying dollars from you guys at 85.2, a banker would be selling dollars to you at 85.6. Bid rate, guys, is bankers buying rate, ask rate is bankers selling rate. But we always think from the viewpoint of customer, not from the viewpoint of banker. Alright, guys. So when you talk from the viewpoint of customer as such, guys, remember, customer will always buy at a higher price, customer will always be able to sell at a lower price. Basically, a customer will always lose on account of immediate buying and selling. If you buy and sell without any time gap, you are supposed to lose. Okay, so bid rate as such, guys, is customers selling rate, ask rate is customers buying rate. Simply remember that a customer will always lose on account of immediate buying and selling. That is why beta the rate at which a customer will be able to buy will always be greater than the rate at which a customer will be able to sell foreign currency. It is very important to identify, guys, what is a commodity. ये जो buying rate and selling rate है, it is always in terms of commodity. So when you say, guys, the buying rate and selling rate are in terms of commodity, imagine if the question says that you're supposed to buy rupees. Just because you're buying rupees, that does not mean ask rate will be applicable. You will have to first check what is the commodity in the given quote. Is it rupee or is it dollar? A majority of the questions of hedging as such, guys, had it the other way around. Okay, so that is why you will not simply go by importer or exporter as such, guys. You will have to see whether we are buying foreign currency or whether we are selling foreign currency, and if that is a commodity, the currency that you are buying, if that is a commodity, ask rate will be applicable. The currency that you are selling, if that is a commodity as such beta, then bid rate will be applicable. If you choose the wrong rate, the entire conversion process will go for a toss. Are we clear about this, guys? So any question, first step, identify commodity. Then beta, see what is the transaction that you would want to execute. In that transaction, what are you doing with the commodity? Then decide whether it is bid rate or ask rate. It will barely take 5 extra seconds, but write the entire sentence like that we used to write in the class beta. That this is a commodity in the given quote and we are buying or selling the commodity, therefore bid rate or ask rate will be applicable. Are we clear about this, guys? After the concept, guys, of one-way quote and two-way quote as such, guys, I gave examples in the class as such, guys, wherein we converted foreign currencies as such, guys. Matlab application of bid rate and ask rate. I gave certain example as such, but and I said in case I want to buy dollar, guys, because in the given quote, the rate that you're seeing in front of the screen, guys, it is rupee by dollar. Dollar is a commodity. Because I want to buy dollar, guys, ask rate will be applicable. In case I want to buy rupees, guys, buying rupees would mean that you are selling dollars, and because dollar is a commodity, guys, bid rate will be applicable. If you would want to sell rupees as such, guys, that means you are buying dollars. Again, because you're buying dollars, beta, ask rate will be applicable. After this, guys, we moved on to the concept of bid-ask spread. Bid-ask spread as such, guys, is the difference between bid rate and ask rate. But this, in case they ask it in percentage, guys, it should always be divided by bid rate, not an average of bid rate and ask rate. Never asked in the examination, but it can still come as a part of MCQ. The difference between bid and ask rate will always depend on the underlying liquidity in that currency, guys. If the currency is something better that is frequently traded in the market, has a lot of liquidity, then the difference better will be lower. But if it is something that is illiquid as such, guys, the difference would be higher. To compute bid ask spread in percentage, you will always write bid rate minus ask rate. Divide that by bid rate as a percentage of bid rate. After that, beta, we moved on to the concept of spot rate and forward rate. Spot rate is the rate at which foreign currency, guys, can be purchased or sold in the spot market at the current price on the current date, guys. Forward rate is the rate at which you are entering into an agreement as such, guys, to buy or sell foreign currency, guys, on a later date, but at a predetermined price. All right, guys. The way forward rate will be given, guys, will decide whether they're following outright rate concept or are they giving us swap points. Outright rate matlab they will directly tell us what is the forward rate that is prevailing as such, guys. Swap points beta is the difference between spot rate and forward rate. In case swap points are in increasing order, guys, that means the swap for bid is less, swap for ask is more. So if it is an increasing order, it would mean that forward rate is at a premium. You add the swap points, guys, to your spot rate to arrive at your forward rate. I told you always start from the last decimal point when you're adding swap points. Just in the screen, on the screen beta, you're seeing that it is 120, 200. I'm adding 120 and 200 beta from the last decimal point. Are we clear, guys? Or else follow what they're giving in the question. जैसे अगर question में बोल रहा है बेटा swap point is 0.023, they're already specifying what is the decimal point and everything as such, guys. Then you cannot do that. Are we clear, guys? If the swap points are in decreasing order, beta, what will you do? Subtract it, guys, from your spot rate to arrive at your forward rate. I gave you the logic, beta. Why are we supposed to add? Why are we supposed to deduct? Because the forward ask rate also is always supposed to be greater than forward bid rate, and that rule will continue to apply beta only if you follow this. Swap points are in increasing order, you add. Swap points are in decreasing order, you deduct. Sometimes swap points beta will not be given in terms of, you know, absolute terms. They might give percentage. एक दो question में आया था. You're simply supposed to add those percentages as such, guys. Percentages भी तुमको check करना पड़ेगा whether it is increasing order or decreasing order. If it is an increasing order, add. If it is in decreasing order, deduct. Are we clear, guys? After that beta, we also did the concept of forward premium or discount. Forward premium or discount as such, guys, is basically computing, guys, what is the difference between spot rate and forward rate and expressing that as a percentage. All right. By default, if they use the word forward premium or discount, you're always supposed to annualize it, meaning you're supposed to write it better on a per annum basis. By default, forward premium or discount is always computed on commodity, not on price. So in case they ask us to compute forward premium or discount, the formula beta is F minus S divided by S into 100 into 12 by N. If they give it in months, you write into 12 by N. If they give it in days, beta, you write 365 divided by the number of days. This formula you're using if they give us forward premium or discount on commodity. If they give us forward premium or discount on price, there are two ways. Either invert the quote, make price as the commodity, guys, or simply write S minus F divided by F into 100 into 12 by N. I gave the logic for this formula beta in your concept notes. S minus F divided by F. That will directly give us what is the forward premium or discount as such, guys, on price. These are the formulas. So if it by default, remember, it is always on commodity. You're not going to compute it on price. Only if they ask us to compute it on price beta, the answer will be S minus F divided by F into 100 into 12 by N. Alternatively, you can always invert the quotes beta and use the same formula that we've used before. F minus S divided by S. Then beta, we moved on to the concept of broken period forward rate. This concept, guys, we have used only if they ask us to clearly determine forward rate as such beta. There was one question in which they gave us 2 months ka forward rate, 3 months ka forward rate, and they've asked us to compute 2 months 15 days ka or 2 months 10 days ka forward rate. I told you beta that you're supposed to take the difference between 2 months forward rate and 3 months forward rate. That amount as such beta is for a time gap of 1 month. So if they're asking you to compute it for 2 months 10 days, you take proportionate difference for 10 days. And then beta arrive at broken period forward rate. Are we clear, guys? Yes or no beta? Then guys, whenever we are inverting a two-way quote, guys, समझ में आ गया broken period forward rate? We do not. Broken period forward rate matlab you're using two different forward rates beta to arrive at a forward rate as such, guys, for a period which is between those two periods. Now, inverting a two-way quote, guys. Whenever you are inverting a two-way quote as such beta, we did this when we were doing cross-currency arbitrage or cross-currency rates. In a lot of questions beta, we had to end up computing cross-currency rates. So whenever you are inverting a two-way quote as such, guys, what is important to remember is that ask rate of the original quotation as such, guys, will become bid rate. Bid rate of original quotation will become ask rate of the inverted quote. You are not supposed to do all of this, guys, if you're identifying commodity and then understanding whether bid rate or ask rate will be applicable. See, if I want to sell rupees, that means I'm buying dollars. Dollar is commodity, I'm picking up ask rate. End of discussion. Ab वापिस उल्टा मत लेना that we are inverting the quote, that is why bid rate will be applicable. When will you use this concept? If you're actually computing a cross currency rate, only then you're supposed to use this concept. If you're identifying based on a single quotation whether you're supposed to use bid rate or ask rate, directly go by the bid rate and ask rate that you have computed. Starting में बेटा एक दो लोग गलती करते थे, याद आ रहा है ना वो? So here, guys, when you're computing cross currency rate, whenever you have to invert a two-way quote, bid rate of the original quote will become ask rate of the revised quote. Ask rate of the original quote will become bid rate of the revised quote. I told you the logic is very simple as such, better. In the original quote, bid rate, agar rupee by dollar quotation hai, bid rate would mean it is dollar selling rate and rupee buying rate. If rupee is made the commodity as such, guys, the same rate should be applicable for rupee buying rate and dollar selling rate. The rate cannot change merely because you are inverting it. Are we clear about this? So that is about inverting a two-way quote. Then beta we moved on to the concept of cross currency. I might not have given a note, but I also told you what is PIP beta, price interest point. PIP as such, guys, is the lowest change that is possible in the currency quotation. Jaise beta, if currency rates are given up to 4 decimal points, the lowest change, guys, can be 0.0001. But when we were solving questions on fate of a forward contract, guys, I told you by default consider 0.0025. Only in questions of fate of a forward. Cancellation before expiry, on expiry, after expiry, and all of those questions. Baki sab questions mein beta, if it is 4 decimal points, 0.0001. If it is 3 decimal points, 0.001. Are we clear about this? If question mein beta agar rate 2 decimal points diya hua hai, in your answers also follow 2 decimal points. Question mein rate 4 decimal points de raha hai beta, in your answer also you will follow 4 decimal points. Are we clear about this? Now, cross currency as such, guys, is where the rate between two currencies is not directly available as such, guys, but then we are using an intermediary third currency to establish a rate as such beta between these two currencies. Jaise rupee beta is freely traded against dollar, but rupee directly against dirham as such beta is not quoted. So what are we doing beta? We are using the rate between rupee to dollar, and we are using the rate between dollar to dirham as such beta, and then establishing a rate, guys, between rupee to dirham. So you want rupee to dirham. I said irrespective of what rates are given in the question, ignore them. You first form your equation. How will you form your equation? Simple. तुम्हारे को a by b चाहिए, a हमेशा numerator में रहना चाहिए, b हमेशा denominator में रहना चाहिए. Now you will see, guys, a is quoted against which currency? If a is quoted against c, you will write a by c into c by b. If this is directly available in the question as such, guys, pick it up. If it is not available in the question, you will write 1 divided by c by a, the rate that is given in the question. But when you do this, remember the logic of inverting a two-way quote. If you wanted bid rate here you are supposed to pick up ask rate. Here if you want ask rate, here you're supposed to pick up bid rate. Are we clear about this? So this is cross currency as such, guys. After this beta, we moved on to the concept of currency appreciation or depreciation. Jaise beta, recently dollar is appreciating as such, guys, obviously because of the tariffs that are being imposed as such, guys, and global uncertainties. So if dollar is appreciating as such, guys, which is the currency that is depreciating against dollar? Rupee is depreciating against dollar. But the point to be noted as such, guys, is that the percentage change in one currency will not be equal to the percentage change in the other currency. That means if dollar is increasing by 5%, that does not mean rupee is decreasing by 5%. The logic is exactly the same as profit as a percentage of selling price, profit as a percentage of cost. Are we clear, guys? Absolute change same rahega, guys, but the base on which you are computing as such, guys, will differ. So I told you how are you supposed to make these changes, guys. If they tell us better that dollar is appreciating by 10%, the same dollar, $1 will now buy more number of rupees. If dollar is depreciating by 10%, the same $1 will now buy lesser number of rupees. You make change to the opposite side. If they tell us that rupee is appreciating by 10%, the same number of rupees will now buy more dollars. So you will write same rupees, 88 rupees for example, will be $1 plus 10%. If rupees is depreciating, the same number of rupees will now buy lesser number of dollars. That is currency appreciation or depreciation. Any doubt in this, guys? Identification of price and commodity, I started that in the beginning only, guys. I told you as to how will you identify, guys, which currency, which is the commodity. By default, guys, if they use the word equal to, what will be the commodity, guys? Denominator is the commodity, numerator is the price. After that, beta, we moved on to the concept of interbank rate, guys, and merchant rate. Yes or no, guys? अब यही प्रॉब्लम है, थोड़ा यहाँ पे लिखा, थोड़ा वहाँ पे लिखा मैं. Anyways, guys, interbank rate as such, beta, is the rate at which two banks as such, guys, or two authorized dealers as such, guys, will be executing a transaction. If the question tells you that the banker, guys, has entered into a purchase contract in the interbank market, banker in turn is becoming the customer. That transaction is not with the end customer, beta. Banker is executing a transaction in the interbank market, so banker itself, beta, is becoming customer. If banker is becoming the customer, guys, you still go by the same logic. Bid rate is customers selling rate, guys. Ask rate is customers buying rate. समझ में आ रहा है? वो confusion कहाँ था? Sir, banker खरीद रहा है ना, तो उल्टा रहना चाहिए. When will that ulta apply? When the banker is executing the transaction with whom? Customer. When the banker is executing a transaction in the interbank market, guys, he in turn is becoming a customer. Are we clear about that? So interbank market as such, guys, is the rate as such, beta, at which a banker will be able to execute a transaction, guys. Merchant rate as such, guys, will be your interbank market adjusted for exchange margins. All right, guys. So in case they give us interbank rate, guys, and they ask us to find out what is the rate, guys, at which the foreign currency will be purchased or sold to the customer, what will you do? Adjust exchange margins. You're always supposed to add margin to ask rate. You're always supposed to deduct margin, guys, from bid rate. One important point that you should know here, guys, in case they mention separate margins for buying rate and selling rate, the margins are from the viewpoint of banker. जैसे margin for buying rate बोला, margin for selling rate अगर बोला, guys, it is margin for bankers buying rate, which will become customers selling rate. If they say margin for selling rate, it is bankers selling rate, customers buying rate. याद आ रहा है वो? Because in forward computations, beta, they used to give separate margins, guys, for buying rate and selling rate. Any doubt in this, guys? After this, beta, we moved on to the concept of cover transaction. Cover transaction, guys, is whenever a banker is entering into a transaction with the customer as such, beta, the banker will want to immediately hedge his position. If the banker is entering into a spot transaction with the customer, banker will do the opposite in the spot market. If the banker is entering into a forward transaction with the customer, banker will do opposite in the forward market. So if I am an importer customer and I'm going to the banker as such, guys, to buy foreign currency from him immediately, the banker in turn will buy that foreign currency as such, guys, from the interbank market and give it to me. I repeat, banker is going to buy that foreign currency from the interbank market and give that foreign currency to me. Are we clear about this, guys? So in case banker has entered into a spot transaction, guys, to sell foreign currency to a customer, banker will buy foreign currency in the interbank market. In case the banker has entered into a contract to buy foreign currency, guys, from the customer, banker will enter into a contract to sell foreign currency in the interbank market. The difference between these two rates as such, guys, will become his profit or loss. Usually it should be gain as such, guys. It should not result in a loss because they will obviously levy exchange margin. If there is no time gap as such, beta, practically the difference should be equal to exchange margin. You buy in the interbank market, you sell it to the customer, beta, at merchant rate. जो भी difference है बेटा तुम्हारा, that will become your profit markup. But अपने questions में ऐसा नहीं रहता बेटा, वो अलग ही रहता. He will tell you that you entered into spot sale and then you immediately covered yourself in the interbank market. When the banker is entering into interbank transaction, do not forget margins will not be applicable. Is that clear? So that's a cover transaction. After that, beta, we moved on to the concept of cross currency arbitrage. Cross currency arbitrage arises, guys, when a specific currency as such, guys, is mispriced in different markets. To arrive at cross currency arbitrage as such, guys, I told you keep any one quotation as the base. जैसे on the screen you see rupee by dollar, dollar by pound, rupee by pound. Keep any one quotation as constant, guys. Arrive at the rate of that quotation using cross currency market. In case I keep rupee by US dollar as the base quotation, I will compute rupee by dollar, guys, using cross currency market. All right, guys. जो भी cross currency से आ रहा है बेटा, that will become fair rate as such, guys, and that is the actual rate. So in our example, guys, using cross currency market, we got 86.4097, but the actual rupee to dollar rate as such, guys, in the spot market is 85.5. What you should check, guys, whether in the actual market is dollar underpriced or overpriced. वापस बोल रहा हूँ, cross currency में नहीं, in the So dollar का rate cross currency से compute करो against rupees, and against which currency is also important. A lot of you made mistakes as such guys that. So once you identify guys whether dollar is underpriced or overpriced, याद है बेटा सौरभ, अपन दूसरी currency के against ले लिए थे पूरा. हाँ. So rupee to dollar quotation है, that means dollar is underpriced or overpriced against rupees as such guys. In our example, dollar is underpriced. I asked you to form a triangle like this: rupee, dollar, pound. ठीक है? Now dollar is underpriced. That means you are going to buy dollars. So यहां से यहां जा रहे हो. Once you identify this flow of transaction, all the other flow of transactions will follow. This was your start point. Just because this is the start point in identifying flow of transaction, that does not mean better to compute gain or loss. You start with rupee to dollar conversion. That will depend on what is the currency given in the question. They might tell you, better assume we have $10,000. If you assume that you have $10,000, what is the first transaction that you will execute here? Sell dollars, buy pounds. गलती से भी rupees खरीद लिए समझो, गया पूरा. कुछ नहीं बेटा, opposite करो, वापस profit आता. So if you start with $10,000, you will sell dollars, buy pounds, you will sell pounds, you will buy rupees, use those rupees better to buy dollars. Whatever is the end amount guys that you are ending with and the start amount, difference ko vida will become your gain or loss. It should always result in gain guys. It cannot result in a loss because you're talking about arbitrage. समझ में आ गया? So what are we supposed to do guys? If they give us 3 rates, keep any one currency as base, identify the rate of that currency using cross currency market, check whether the base currency that you put aside beta, is it underpriced or overpriced. If it is underpriced, you have to buy that currency. If it is overpriced, you have to sell that currency. Just if dollar was overpriced, I would have sold dollars and purchased rupees. Then all the flow of transaction would be reverse. उसके बाद में you can start with any currency guys, $10,000, 10,000 rupees, 10,000 pounds as such guys, to compute the amount of gain or loss. Usually they will specify that in the question guys. उसको क्या बोलते हैं? Cross currency arbitrage. I have given examples also as such guys in your materials, concept notes. ठीक है? Then guys we moved on to the concept of computation of forward rate. So for computation of forward rate guys, we did 2 theories as such guys. One was interest rate parity theorem, the other one was purchasing power parity theorem. IRPT states as such guys that whatever is the rate as such beta that is supposed to prevail as such guys in the forward market should be in line with the interest rate differential as such guys. So when you say interest rate differential as such beta, the interest rates prevailing in the market will determine what should be the likely forward rate beta that will prevail. Practically guys, it does not merely depend on interest rate, it also depends temporarily beta on the demand and supply. Just say right now guys, it is based on demand and supply. Because of global uncertainties as such guys, people think that the Indian markets will not perform well. If Indian markets are not going to perform well beta, there are investors who are taking out their money as such guys. So they will sell their stocks in the Indian market, they will realize rupees. What are they going to do with rupees? Sell rupees, buy dollars. Are you creating a demand beta for dollars? What do you think will happen to the dollar rate? It is going to increase, not just against rupees beta, against any other currency. Dollar is increasing now because of this uncertainty. Agar tariffs actually aa gaye beta, don't you think beta countries like India will suffer? Their production exports will come down beta, profitability of the organizations is going to reduce. RBI intervenes as such guys. They will try to offload dollars. They did that last week as such guys. Open market, this week I mean. They did open market operations beta. They're offloading dollars as such guys. In spite of that, imagine as such beta that the decline was restricted. Agar wo nahi karte beta, it would have been even more worse. Are we clear guys? So interest rate parity theorem के हिसाब से बेटा your forward rate will be equal to spot rate multiplied by 1 plus interest rate of numerator currency divided by 1 plus interest rate of denominator currency. You see guys on the screen that I've given an example where the spot rate is $1 is equal to 85 rupees, interest rate in dollar is 4.5%, interest rate in rupees beta is 7%. If you have an option of investing $1 in India, $1 in US or 85 rupees in India, after 1 year you should still be indifferent. So that is why 85 rupees plus 7% was equated to $1 plus 4.5%. That is giving us what is the likely rate as such beta that will prevail. I told you guys, study materials mein they use the word home currency divided by foreign currency. I said let us not go by that because not necessarily always home currency should be the price. Isliye what will you remember guys? It is always numerator currency divided by denominator currency. Purchasing, if forward rate is for 3 months, you take interest rate only for 3 months guys. If forward rate is for 6 months, you take interest rate for 6 months. If it is continuous compounding guys, you will write into e power RT. Spot rate into e power RT divided by e power RT. It is similar to forward rates beta that we did for derivatives. Under derivatives guys, वहां पे प्रॉब्लम क्या था बेटा, इज दैट देयर इज ओनली वन कमोडिटी एज सच गाइस. यहाँ पे दोनों करेंसीज है, दोनों पे इंटरेस्ट रेट है, इसीलिए बेटा डिनोमिनेटर में भी कुछ आ रहा है. आर वी क्लियर? Next guys, we moved on to purchasing power parity theorem guys. Under purchasing power parity theorem guys, relative purchasing power, it says guys that the interest exchange rates as such guys will depend on the inflation rates that are prevailing. Basically guys, your purchasing power in different currencies should not change. The amount of commodities that you're able to buy today as such guys should exactly be the same as such guys on a later date also. So that is why instead of taking the entire interest rate as such guys, we take inflation rates into consideration. That's the only difference. Now what is important better to note is that for interest rate parity theorem, we take nominal interest rates. We do not take real interest rates. So they might ask us to compute real interest rate guys. By default guys, if they give both inflation rate and interest rates, which one are you going to use? Interest rate parity theorem. That makes more sense better rather than taking only purchasing power parity theorem. Those interest rates are also based on what guys? Nominal interest rates. 1 plus nominal interest rate will be equal to 1 plus real interest rate into 1 plus inflation rate. In case the question tells us better that the short term interest rates prevailing in India are 8% and you will be able to borrow at 12%. Will you take 12% in IRPT or will you take 8%? 8%. Exchange rates are not based on the rate at which you will be able to borrow guys. Exchange rates will be based on interest rates that are prevailing in the entire economy. Are we clear guys? After this beta we moved on to the concept. ये समझ में आ गया ना सबको? We moved on to the concept of covered interest arbitrage. Covered interest arbitrage as such guys basically means as such guys that you will be borrowing in one currency, lending in the other currency guys, and make an amount of riskless profit. This arises guys when fair forward rate computed as per IRPT does not match with actual forward rate. Let us say guys, in our example beta, fair forward rate as per IRPT was 87.452, but actual forward rate beta is 86.5. What is the commodity here? Dollar. Let us not forget that guys. In the code that you see in front of the screen beta, dollar is the commodity guys. In the actual forward market guys, is dollar underpriced or is dollar overpriced? Dollar is underpriced. Whenever something is underpriced, will you buy that or will you sell that? So you are supposed to enter into an agreement guys to buy dollar in the forward market. You will immediately do the opposite guys in the spot market. Yes or no guys? You are entering into a contract as such guys to buy dollar in the forward market. Forward market में भी अगर वापस sell कर देना बेटा वो nullify होकर contract cancel हो जाएगा. You should always take the opposite position in the spot market guys. समझ में आ रहा है बेटा? So you buy dollars in the forward market. Immediately guys you will sell dollars in the spot market. To sell dollars you need to have dollars. That means you're going to borrow in dollars, sell those dollars. The dollars that you're receiving, sorry, the rupees that you're receiving as such beta will be deposited. Whatever rupees that you receive on maturity as such guys, with that you're going to buy back dollars at the agreed forward rate. I repeat, I'm borrowing dollars. I will sell those dollars at spot rate. By selling, I will receive rupees. I am going to deposit that rupees. The rupees that I receive on maturity, guys, because I'm depositing rupees today, won't I receive rupees on maturity? I will use that to buy dollars at the agreed forward rate. Whatever is the dollars that you're receiving, guys, minus the dollar that you will have to repay on your dollar borrowing will become your profit. Is that clear, guys? Likewise, beta, in case the actual forward rate is 89 rupees per dollar where the fair forward rate was 87.5. Is your dollar overpriced in the forward market now? So what will you do under covered interest arbitrage? Because dollar is overpriced as such guys in the forward market, you are going to sell dollars as such guys in the forward market, opposite contract in the spot market, that is you buy dollars in the spot market. Now guys, when you are buying dollars in the spot market as such guys, that means you will have to hand over rupees. You will be receiving dollars, you will have to hand over rupees. So you will have to borrow in rupees, you will deposit in dollars. This will be the flow of transaction guys. So you start with borrow in rupees, use that rupees to buy dollars, deposit in dollars. The dollars that you're receiving on maturity as such, but you will sell that at the agreed forward rate. Use that rupees as such guys to repay your rupee borrowing. You will be left with a surplus. That will become your gain. Are we clear about this guys? After This beta covered interest arbitrage, guys. So far beta I just told you what are the different types of quotations, how to compute forward premium or discount, guys, and then how are we supposed to compute cross currency rates, guys. What is merchant rate, interbank rate, what is covered interest arbitrage, what is a covered transaction. Now we are moving on to hedging, guys. Under hedging beta I told you that we have internal hedging techniques and we have external hedging techniques. Under external hedging techniques beta, there is forward hedge, there is futures hedge, there is options hedge, and then there is money market hedge. Internal hedging mein beta, one option is that you can directly invoice in home currency, guys, or guys you can lead, that is pay before the due date, or lag the payment, pay after the due date. You can net off your transactions, guys. Matching as such beta is match a receivable against a payable, guys. Asset liability management, price variation, bill them a separate amount on a later date, guys. Is that clear beta Vidhi? So under external hedging as such, guys, the first one beta is forward. Forward hedging, it is very simple, guys. In case you have a receivable in foreign currency, you should enter into a forward contract, guys, to sell that foreign currency. Not always beta foreign currency will be the commodity. So it is very important to identify as such, guys, whether you are buying or selling. Not so much relevant, guys, for a forward hedge, but very much relevant for a futures hedge, because it is going to be settled in cash on the expiry date. फॉरवर्ड हेजिंग में बेटा इट इज डिलीवरी सेटलमेंट अनलेस अदरवाइज गिवन. डिलीवरी सेटलमेंट मतलब ये लो तुम्हारे डॉलर पैसा दो, या फिर ये लो तुम्हारे रुपीस डॉलर दो, जो भी है बेटा. सो इन केस यू हैव अ रिसीवेबल इन फॉरेन करेंसी, यू विल एंटर इनटू अ फॉरवर्ड कॉन्ट्रैक्ट टू सेल फॉरेन करेंसी. इन केस यू हैव अ payable in foreign currency, you will enter into a forward contract, guys, to buy foreign currency. They might ask us to compute gain or loss, guys, on account of forward hedging. All that you have to do beta is compare what would have been the receivable or payable had there been no hedging with what is the amount of actual receivable or payable beta under hedging. There was only one question of forward hedge, guys, in which they also mentioned forward premium. Usually forward hedge does not result in any premium, guys. There was one question in which we had to pay an upfront premium of 1% or something, guys, of the entire amount of forward purchased. In that question, guys, I said we have no other option. We will have to consider that forward premium and also consider opportunity cost, because borrowing cost, because the premium was paid upfront. याद आ रहा है बेटा? So forward hedge में बेटा कुछ भी नहीं रहता. Simply convert foreign currency at that agreed forward rate. Only in one question we also had premium, guys, and opportunity cost and that forward premium. Are we clear about this? Then beta we moved on to option hedging. Under option hedging, guys, I said it is very important to identify what is the commodity given, guys, in the option quotation. Is it foreign currency, guys, or is it home currency? Then depending on whether you have a receivable in foreign currency or payable in foreign currency, you will have to decide whether it is call option or put option. In case you have a receivable in foreign currency, your objective beta will be to sell foreign currency, buy home currency. If foreign currency is the commodity, it is put option. If home currency is the commodity, it is call option. पूरा change हो जाता guys. If you have a receivable in foreign currency, your intention is to sell foreign currency. If your intention is to sell foreign currency, guys, what will you do? You should enter into a put option if foreign currency is the commodity. You will enter into a call option, guys, if home currency is the commodity. Yes or no, guys? In case you have a foreign currency payable, your intention beta will be to buy foreign currency. In case foreign currency is the commodity, you enter into a call option. If home currency is the commodity, you enter into a put option. Now, every question of option, guys, there will be premium. What is important to note, guys, is again check whether the premium is in home currency or foreign currency. If the premium is in home currency, very simple. Take premium amount, take opportunity cost on premium. Yes or no, guys? Wouldn't there be opportunity cost on premium? If the premium is in foreign currency, convert that also, guys, into home currency at spot rate, and then also take opportunity cost on that. One additional computation will come if the premium is in foreign currency. One, now you will have to take premium upfront as such, guys. You should take opportunity cost on that. In case they give us price on expiry, guys, different prices, compare strike price with each of the price as such, guys, and then determine what is the likely inflow or outflow. In case they do not give anything, assume that the option is exercised and directly convert at exercise price. Majority of the questions we did this only, guys. They did not give us what are the prices prevailing on expiry except one question. If you recall, the prices were $1.91, $1.95, $2.05 or something. We had to compare, guys, at each price and then we decided whether we are going to exercise the option or not. अगर कुछ नहीं दिया तो क्या करेंगे? Directly convert at exercise price. Are you all following this? Now, guys, another important point. What if contract size is given? You enter into option contract as such, guys, depending on the number of contracts as such guys. बाकी का amount as such बेटा, you may have to enter into a forward contract or you will directly have to convert that at spot rate prevailing on expiry, depending on the information. I made you clearly write notes related to this guys. Depending on the sentences used in the question, you will know whether we are entering into a forward contract or whether we will directly convert that at spot rate. So this is about what guys? Option hedging. What is money? समझ में आ गया? So forward hedge में no calculation only, directly convert at forward rate. Contract size नहीं रहता, कुछ नहीं रहता guys. It is an over the counter contract. Option contract में identify whether it is call option or put option. There will be premium that you will have to pay upfront. There will be borrowing cost on the amount of premium that you will have to pay upfront. Correct, beta Isha? And then guys, you will have to convert. If nothing is given, convert the entire amount at exercise price. In case they give lot size, you may have to convert the remaining amount at either agreed forward rate guys or at spot rate prevailing on expiry. This is option hedging. After that as such beta is money market hedge. What do you do under a money market hedge guys? Under a money market hedge as such guys, you are basically as such beta creating a receivable or payable as such guys in the foreign currency itself. In case you have a foreign currency payable as such guys, you will create a receivable in foreign currency by depositing in foreign currency today itself. In case you have a foreign currency अभी पेएबल बोला था क्या? हाँ. In case you have a foreign currency payable guys, you are going to create a foreign currency receivable. This is as good as covered interest arbitrage, but then here we do not have guys, sorry, here we have an underlying receivable or payable. So money market hedge I told you beta effectively will give us conversion at the same rate as such guys as fair forward rate. याद आ रहा है कुछ? The effective amount of inflow or outflow under a money market hedge guys will exactly be equal to your fair forward rate. Guys, believe me, all of this will be very useful as such guys when you're going to revise later. जो भी मैं points cover कर रहा हूँ. So under a fair money market hedge as such guys, again simple. If you have a foreign currency payable, what should you do? Create a foreign currency receivable. कैसे create करने वाले हो sir? You will have to deposit in foreign currency today. How will you compute what is the amount to be deposited? So that the amount that is receivable on maturity is equal to your foreign currency payable. Whatever you have to deposit today, you will have to buy that at the spot rate prevailing. To buy that, will you need currency in home currency? You will have to borrow. On that borrowing, you will have to consider your borrowing cost. Ultimately, if you have a foreign currency payable, you will have a home currency borrowing. Ultimately, if you have a foreign currency receivable as such guys, you will have a home currency deposit. कुछ भी कर लो बेटा, that is the whole point. Because you're depositing or borrowing today only guys, you will not be affected by exchange rates prevailing on a later date. Are we clear about this? So that is what beta? Money market hedge. Any doubt in that guys? If you look at the example guys, यहाँ पे I have a spot rate of 85 rupees per dollar guys, interest rate in rupees is 10%, interest rate in dollar beta is 7%, and we have a payable of $10,000. So you will deposit some dollars today so that the amount that you receive on maturity is exactly equal to $10,000. We got that as 9,345. What will you do now? Buy $9,345 at the spot rate of 85. For that beta we need 7,94,000 rupees. What will you do? Borrow 7,94,000 rupees. Whatever borrowing पे repayment करना है, that is your effective outflow. Are we clear guys? After money market hedge as such guys, fade or forward नहीं बेटा, मेरे को सबसे main पढ़ाना था futures hedging guys. Cash settlement. बाद में we will go to fade or forward. I skipped a certain part guys. So let us go to futures hedging guys. Whenever they talk about futures as such guys, please remember that it will be settled in cash. They are going to give you lot size. Compute the number of contracts that you are entering into as such guys. Very important to identify whether you're entering into a future purchase contract or a future sale contract. पूरा profit बदल जाएगा guys. Profit might become loss, loss might become profit. And purposely beta they will not give home currency as a commodity, home currency as the price. They will make home currency as the commodity. रट्टा मत मारना ऐसे. Go by the quotation. क्या होता बेटा? Say if I have a foreign currency payable, by default beta we will think that we will enter into a forward purchase contract. हाँ या ना guys? But यहाँ पे because if foreign currency is the price and home currency is the commodity guys, you have to buy foreign currency and sell home currency. You are not going to enter into a forward purchase contract anymore. You will now enter into a forward sale contract. So it's very important to identify whether you're entering into a forward purchase contract or a forward sale contract. Unless otherwise given, all futures contract will be settled in cash. So what are you going to do under futures hedging? First step, see how much is the foreign currency receivable or payable. See what is the future rate that is prevailing today. Based on future rate that is prevailing today, you will compute what are the number of contracts to be executed. Once you compute number of contracts to be executed, guys, on expiry, for these contracts, you will compute what is the profit or loss on settlement. You do not have to worry about unhedged exposure, क्योंकि cash settlement है. I repeat, you should not worry about unhedged exposure. Sir, what if number of contracts are not exactly rounding off number? फर्क नहीं पड़ता. Settle futures on expiry as such, guys. Once you settle futures on expiry, combine that with foreign currency receivable or payable, convert the entire amount at spot rate prevailing on expiry. Convert the entire amount as such, guys, at the spot rate that is prevailing on expiry. समझ में आ रहा है नहीं आ रहा है, guys? 1 second, बेटा. Can you just tell me the question in case you have? $50? One second, guys. Sorry. Oh my God. So this was, guys, our money market. So this was an example as such, where cash settled. So on the transaction date, guys, future rate is given. We know the contract size. We know how much is the foreign currency receivable. We computed number of contracts. On the expiry date, first thing that we're doing, beta, is we are settling our futures. We computed our profit or loss, guys. Whatever is the profit or loss as such, guys, along with the foreign currency receivable will be converted at spot rate. One question, guys, they gave us initial margin on futures. कुछ नहीं करना. Initial margin is not your expenditure. Only borrowing cost on that is your expenditure. Based on number of contracts, you will have to see how much is the amount that you're depositing today, guys. On that, whatever is the amount of margin as such, on that, whatever is the amount of borrowing cost. वो याद है ना, मुंबई based entity बोल के 2 questions standard थे. Same questions as such, guys. So in that you will have to consider borrowing cost. Are we clear about this, guys? So this is about what, beta? Futures hedging. After that as such, beta, we moved on to the concept of internal hedging. Under internal hedging, एक second, beta, just give me a minute. Under, थोड़ा यहाँ लिखा, थोड़ा वहाँ लिखा, बेटा, मैं तुम बच्चे ऐसे हो. Under internal hedging as such, guys, we moved on to the concept of what, guys? First, leading and lagging. Leading as such, guys, is where you make the payment before the due date. Lagging as such, beta, is wherein you make the payment after the due date. So in case there is a leading contract as such, guys, remember, you may get discount. So adjust that from the total invoice price, and usually this will only be in respect of payable. Receivable mein, beta, how the hell will we have an option to decide whether it is leading or lagging? You just have to compute what is your total effective outflow. Please do not discount, compound. थोड़े बच्चे पूछे थे, सर, why are we not discounting it? एक ऑप्शन में immediate outflow आ रहा है और एक ऑप्शन में 3 months के बाद में outflow आ रहा. I said you are not supposed to do that. Do not discount 3 months outflow. In fact, add borrowing cost to your spot amount that you are paying as such, guys, and then compute the effective outflow. That is leading and lagging. Netting का मतलब क्या है, बेटा? In case you have receivables or payables as such, guys, in respect of subsidiaries as such, guys, at multiple locations, we use the word netting as such, guys, for our own internal group company transactions. उसमें भी there is bilateral netting and then there is multilateral netting. Bilateral netting मतलब two subsidiaries have receivable and payable. First set off that amount, that is bilateral netting, then go to multilateral netting. कुछ भी नहीं है, guys. There was a question of Indian subsidiary, Malaysian subsidiary, US subsidiary. I said convert everything into common currency first and then add the column totals. Whatever is the column total as such, beta, will be your net receivable or payable. Indian, याद है, UK was a home corporate entity as such, beta. We converted everything into pounds. That is netting. Matching, guys, we did that along with external hedging. We exported goods to some European country. We also imported goods from European country. We have a receivable in euros. We also have a payable in euros. I said do not hedge receivable separately, payable hedge separately. What will you do? Net off the amount as such, guys, provided they are receivable and payable at the same time. If I have a receivable of 5 months but payable in 3 months as such, guys, I cannot net it off. Are we clear, beta? Guys, some more time as such, guys. Let's finish. That is matching, guys. Price variation में क्या करो बोला बेटा मैं? You will have to bill the supplier as such, guys, separately. Are we clear, guys? For the exchange rate, that is not going to happen practically, beta. It's not so simple as such, guys, to bill the supplier for the, matlab whatever loss that you're incurring as such, guys, you're going to bill the supplier. Next, guys, fate of forward contract. Whatever I'm revising here guys in fate of forward contract is also a quick revision, do not forget. In case तुम लोग बाद में पढ़ रहे हो, तुम्हारे को फिर भी doubt आ रहा है guys, let me know. I will take a detailed revision session only on fate of forward contract as such guys. It is very important for exam, I told you guys, very very important. So under fate of forward contract as such guys, I told you there are 9 cases possible. It can be cancellation, delivery, extension. 3 cases guys. 3 cases के लिए भी before a due date, on a due date, after a due date. The cases that you are supposed to separately remember is delivery before due date and all the 3 delivery, extension, cancellation after a due date. ये 4 cases ही है बेटा जिसमें अलग treatment है. बाकी पूरा बेटा तुम्हारा natural instinct will give you the right answer. You do not have to read that separately. I repeat, delivery before due date and cancellation after due date, delivery after due date, extension after due date. These are the 4 cases for which you will have to remember separately. Now let us talk about guys cancellation before due date. Very simple, just like any other transaction that we did in derivatives question. How will you remember this guys? Say today I have entered into a Reliance futures that is maturing in the month of April. I purchase Reliance futures. Tomorrow if I want to cancel this contract guys, कौन सा future sell करना है मेरे को? Reliance का. कौन सा future? Feb वाला या April वाला ही? April wala. I entered into a contract guys of April futures today. Tomorrow if I want to cancel, I will have to enter into an opposite position but the same April futures. So what will you remember? If you want to cancel a forward contract before due date, enter into an opposite contract for the remaining period to maturity. ये remaining period to maturity beta is common sense. If you have purchased, I'm repeating again, April futures, you should sell April futures only. So if at all it is cancellation before due date, very simple, you just have to enter into an opposite contract as such guys for the remaining period to maturity. Are we clear about that? In case you want to extend before due date, you first cancel the existing contract and then enter into a new contract as such guys for the remaining maturity. I repeat, you cancel the existing contract and then enter into a new contract for the remaining maturity. Point to be noted here guys, तुम्हारा जो cancellation rate रहेगा, in case they give interbank rate, please adjust exchange margin because customer is entering into this contract with the banker. Even the original contracted rate, do not adjust any margins because that will be inclusive of margins. You should adjust margin only to your cancellation rate and new contract rate. If it is extension before due date, you will cancel the existing contract and then enter into a new contract. Cancellation rate पे margin लगेगा, new contract rate पे भी margin लगेगा. Original contracted rate that is given in the question is already inclusive of margins. Nothing will apply to that. So this is what extension before due date, cancellation before due date. If it is cancellation on a due date, you are still entering into an opposite contract for the remaining period to maturity. But the problem here beta is remaining period to maturity is 0 days. That is why what is the rule that we have learned? It should be cancelled at the spot rate that is prevailing on expiry because spot rate on expiry is equal to your forward rate. Are we clear about this? So if it is cancellation on due date, simply opposite rate, opposite contract beta at the rate that is prevailing on the cancellation date, that is spot rate beta. If it is extension on due date, cancel on the due date and then enter into a new contract. If it is delivery on due date, simply deliver and receive whatever amount that you have agreed as such guys as per the original contracted rate. This is what you were supposed to do. Any forward contract as such guys is supposed to end with delivery on due date. Are we clear about this? इसके बाद में बेटा first case that we spoke about beta was delivery before due date. I spoken about all of these cases guys. Extension, delivery before due date में beta, if you look at the screen, the example that is also there in your concept notebook guys, customer has entered into a forward sale contract as such beta, $10,000 at 85.45. After 1 month, the remaining period to maturity is 86.85, 87.05. Spot rate is given. I told you guys for your practical understanding, it is very simple. तुम्हारे को deliver करना है due date के पहले, simply cancel the existing forward contract and then deliver at the spot rate that is prevailing. काम ही खत्म. Yes or no guys? But I told you but as per FEDI regulations, you do not do that. If it is delivery before due date, you still deliver at the agreed forward rate, but this will be subject to 2 charges. One is swap loss, the other one is interest on outlay of funds, if any. ठीक है? Swap loss, interest on outlay of funds, or fixed charges also अगर वो apply कर रहा तो that will be given in the question. Fixed charges like 100 rupees or something guys, but usually only 2 charges. I repeat, common understanding के लिए क्या करना है guys? It is as if you are cancelling the original forward contract and then you are settling the contract at the spot rate. But अपने लिए बेटा एग्जाम में you cannot do that. What are you supposed to do? FDI regulations के हिसाब से the original contracted rate subject to swap loss guys and interest on outlay of funds if any. For all of this you will have to understand what the banker did guys. So in case a customer has entered into a forward sale contract, banker is entering into a forward purchase contract. ध्यान से सुनना and refer to the notes as and when you're watching this video later. Have the notes open as such guys so that you refer to the example. So you are entering into a forward sale contract, banker has entered into a forward purchase contract. To hedge himself, banker must have entered into a forward sale contract in the interbank market. तुम जा रहे हो ड्यू डेट के पहले, banker will have to cancel his forward sale contract. To cancel his forward sale contract, banker will enter into a forward purchase contract. तुम्हारे वजह से he is entering into a new forward purchase contract. I repeat guys, customer original contract, customer forward sale, banker forward purchase. To hedge himself, banker has entered into a forward sale contract. Because you are going to him before the due date as such guys, banker will have to cancel his forward sale contract for which he is entering into a forward purchase contract. And the dollars that you are giving him today guys, he will have to sell it at the spot rate. So the two new contracts that is entering because of you is he's entered into a forward purchase contract, he's entered into a spot sale contract. In दोनों का difference becomes your swap loss. Whenever you're computing swap loss, you just have to see because of us, what are the two additional contracts that the banker is entering into. It is beneficial only to us beta because banker जब execute कर रहा है beta सब transaction, margins are not applicable. If you were to cancel contract and then sell at the spot rate guys, margins would have been applicable. So swap loss is beneficial. Other concept here is interest on outlay of funds. इसमें you will have to see guys underlying transactions where the banker is actually receiving and paying rupees. Is because you're delivering the dollars to banker before the due date, is the banker giving you rupees? Also is the banker selling those dollars in the spot market? In दोनों का difference, if it is outflow, banker will charge interest as such guys for the remaining period, that is till the due date. He's supposed to charge interest not less than the prime lending rate as such guys. Prime lending rate मतलब उसका minimum rate as such guys, not less than that. Are we clear? If it is inflow at his discretion, he can give the amount. This is what you're supposed to remember. Very simple. So if it is delivery before due date, execute the contract at the original rate, then swap loss and interest on outlay of funds. Swap loss के लिए क्या check करोगे? तुम्हारे वजह से what are the additional contracts that the banker is entering into. So you'll have to see what is he doing to cancel his hedge position and then what is he doing in the spot market. To compute interest, you have to only check those transactions where there is actually inflow and outflow of rupees. Simple guys. That will tell us how much is the net inflow of funds or outflow of funds. अब आता है बेटा the last case which is after. अरे सारी रीडिंग नहीं लिखा था मैं. नहीं बेटा, it should be in the other book. इसके लिए 1 second guys, online students here. अब वही बेटा वो दो मेंटेन करते करते ना याद नहीं रहता. Extension on due date. Just give me 1 second बेटा. Very good guys. मिल गया, देखो कहाँ जाएगा बेटा. So if it is after due date as such guys, remember I told you beta, as per FDI regulations there are 3 grace days periods as such guys given, subject to which as such guys the contract will be cancelled. So for you guys, you will have to first pick up cancellation rate. Cancellation rate as such guys will be the rate that is prevailing guys on the date the customer approaches the banker or 3 days, whichever is earlier. I repeat, cancellation rate for the customer is the spot rate prevailing on the date the customer approaches the banker or 3 days, whichever is earlier. Cancellation rate is still opposite rate. If the customer has originally entered into a forward sale contract, he will have to now buy. If the customer has entered into a forward purchase contract, he will have to now sell. इसके अलावा बेटा, this is the additional point here, that is exchange difference. That will be cancellation rate and original contracted rate का जो भी difference है बेटा. I gave an example guys, due date is 20th Jan. If the customer approaches on 20th Jan only, then this is not the case that we are talking about. It is cancellation on due date. If is approaching after the due date, that is 21st Jan, you will pick up the spot rate that is prevailing on 21st Jan. If it's approaching on 22nd, spot rate on 22nd. If it's approaching on 23rd or later, it is spot rate on 23rd. Automatic cancellation on 23rd. Are we clear? इसके अलावा there will still be swap loss and interest and outlay of funds. Sir, ये swap loss क्या है? On the due date, guys, the banker will still have to, guys, take delivery of the dollars under his cover transaction. I repeat the process. You have entered into a forward sale contract. Banker has entered into a forward purchase contract with you. In the interbank market, banker must have entered into forward sale contract. उसको तो due date पे deliver करना पड़ेगा dollars. How will he deliver? He will have to buy dollars at the spot rate as such, guys, and sell it at the forward rate. हाँ या ना, guys? Whatever was the agreed forward rate, guys, he will have to deliver the dollars, guys. So he has to buy dollars at the spot rate and deliver the dollars, and is also entitled to enter into a forward contract for the earliest available maturity period, just in case customer comes on a later date. The two new contracts that is entering into because of you beta is buying dollars from the spot market and entering into an earliest available forward contract. Yes or no, guys? In दोनों का difference will become swap loss. I repeat, because of you, he is entering into two new contracts. He is buying dollars at the spot rate and then is entering into forward sale contract for the earliest available forward. In दोनों का difference beta will become your swap loss. That he will recover from you. उसके अलावा you will have to see interest and outlay of funds. What are the transactions on which beta there is actually receipt of rupee or outflow of rupees? He is buying dollars as such, guys, at the spot rate from the market and is delivering at the agreed forward rate in the original forward market. Are these transactions involving inflow and outflow of rupees? Is where you will take interest on outlay of funds for those 3 days as such, guys, depending on whatever is the period. Are we clear? Ho gaya. This is cancellation after due date. So whether it is, so there are 3 things: exchange difference, swap loss, interest and outlay of funds. Exchange difference will be cancellation rate and the original contracted rate. Swap loss will be because of you, what are the two new contracts that the banker is entering into. Interest and outlay of funds beta will be transactions which is involving inflow and outflow of rupees on the due date. I have given detailed explanations, guys, when I was explaining this question in the class. Just go through those explanations, everything will be very clear, but they're dead important questions. Are we clear? So this was about fate of forward, guys. After fate of forward contract as such, guys, what did we do? Types of, we moved on to types of exposures, guys. As far as foreign exchange exposures are concerned as such, guys, I told you there is transaction exposure, translation exposure and economic or operating. अब यहाँ से जो भी है ना बेटा वो छोटे छोटे concepts as such, guys, उतना ज़्यादा नहीं है. मतलब you will have to practice questions, you will automatically know as such, guys. मतलब question solve करना आ जाएगा. Transaction exposure is very simple. I am sitting in India, I am executing a transaction with someone sitting outside India, I am exposed to foreign currency risk. Translation exposure is I have an operation outside India. Whenever I convert that foreign currency financials into home currency financials, there will be certain amount of currency risk. Economic exposure, guys, is because I am sitting in India and operating in rupees as such, guys, and I have current transactions with outsiders. What if dollar is continuously increasing or rupee is continuously increasing? Can that have an impact as such, guys, on my overall profitability? अगर डॉलर अभी continuously बढ़ रहा है, guys, operating exposure for tech companies is favorable. Isn't that profitability automatically increasing, guys? हाँ या ना, guys? बाकी सब companies गिरते जा रहे हैं बेटा, tech companies are increasing because it is favorable to them. The receivables will obviously increase heavily as such, guys. Pharma companies receivable will increase because they have a lot of exposure. But pharma companies still risk है बेटा, it can be still subject to tariffs. Tax पे बेटा ज़्यादा नहीं आ सकता है because they are heavily dependent on Indian companies as such, guys. Are we clear beta? There was this one question, guys, in which we did, if you remember, Singapore से components import करके German वाले को बेच रहे थे, and then beta, हाँ, in the second bit, instead of exporting it in euros, we exported beta in rupees. I computed what is the percentage change in price, and then price sensitivity of demand, so we computed the percentage number of units change. Normal question था, guys, nothing to worry. मतलब there was where we did operating or economic exposure. We computed number of units beta by which the demand is going to change. After this beta, we did strategies for exposure management. Strategies for exposure management beta, there were 4 categories. I asked you to form that matrix type beta: low risk, low reward; low risk, reasonable reward; high risk, low reward as such, guys; and high risk, high reward. Low risk, low reward as such, guys, is you enter into a hedging transactions as soon as you enter into a transaction. High risk, low reward beta is do nothing. high risk low reward as such beta is in where you are not doing anything. Low risk reasonable reward as such guys is in you do not hedge immediately, you wait as such guys and then enter into a hedge transaction when the markets are favorable. High risk high reward as such beta is where you continuously execute buying and selling as such guys in the futures market as such guys to hedge your receivables and payables. After that beta we did Nostro and Vostro account. Nostro account as such guys is wherein an Indian bank as such guys is holding a foreign currency bank balance account as such guys with a foreign bank. Why do they hold guys? For ease of executing transactions. अगर मेरे को यहाँ पे बैठ के as such guys, if I want to remit $1,000 to my sister in US, I'm placing that transaction with HDFC Bank. If HDFC Bank does not have a branch there as such guys, they can have a Nostro account. From Nostro account as such beta, they can directly deliver those $1,000. Are we clear guys? Whoever is getting late beta can leave. I might take another 10 minutes. So Nostro account mein as such guys, you are holding a foreign currency balance account as such guys with a foreign bank. Vostro account beta is where they are holding a rupee account as such guys with an Indian bank. For a Nostro account guys, I told you the questions are very simple. There will be two things that they will ask us to maintain. One is the account itself, that is cash position, and one beta is exchange position. Exchange position guys will have details of all the transactions that you're executing, including forward transactions. Cash position guys will only have those transactions wherein there is an actual receipt and outflow of money. So whenever a bank is entering into a forward contract guys, it will only be entered into exchange position. It will not be entered into cash position. As and when the delivery takes place on a later date guys, it will be entered in cash position. If the forward contract is cancelled, you again enter that only in exchange position. You are not going to record that in cash position. So if it is spot sale, what will you do? Write in both exchange position and cash position. What if it is forward sale? Only in exchange position. What if it is cancellation of forward? Only in exchange position. What if you are issuing a demand draft? Only in exchange position. Issuing a demand draft मतलब यहाँ से किसी से rupees ले रहे हो and you are telling him don't worry, on a later date I will give you dollars. Whoever is encashing that as beta will get dollars. So that is as good as a forward sale contract. Purchasing a bill, as good as a forward purchase contract. ये transactions which I told you to remember. Issue demand draft, purchase of a bill, cancellation of a demand draft guys. याद है नहीं है? These were the only three different cases that we saw. बाकी पूरे were normal guys. In the end they might ask us to maintain certain amount of spot balance guys, certain amount of forward balance. Always first maintain cash balance. See for that how much should you buy or sell. After that check what is the net balance as per your exchange position. Is that clear guys? Then beta we did the concept of return in home currency and return in foreign currency. When you say return in foreign currency guys, you will only take whatever is the return beta that you're generating in dollar terms. Return in home currency will not only be affected by return of your foreign currency, it will also be affected by exchange fluctuation. Classic example that I told you beta, a US investor if is investing in the Indian markets, though the Indian markets might do well, he might still not make a gain if dollar is appreciating and rupee is depreciating. Yaad hai nahi hai guys? So the formula that you see guys on your screen, 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus or minus foreign currency appreciation or depreciation. It will depend on whether the foreign currency is increasing or decreasing. इसके अलावा guys, we might have done few smaller concepts as such guys. ठीक है, छोटे छोटे questions जैसे एक जगह बेटा there was a currency swap question. Some foreign drill matlab company has started drilling an oil field in India. They entered into a swap agreement with the government here. There was one question guys in which we showed whether there is arbitrage or not on account of forward yen or dollar के forward rates ये थे 3/6. याद है? Spot rate for 3 months was given, spot rate for 6 months was given. So there are a lot of small things that we have covered in the end as such guys. You still have to go through all of those questions. In case there's anything else as such beta that you need revision in relation to this, let me know. So that's the end of Forex ka revision as well guys. Do not forget we still have a class left as such guys. I will be messaging. There is no class tomorrow. As and when I'm taking that class as such guys, I'll let you know. Alright. Chalo beta. End of the session. See you guys later. Bye bye.